Welcome to the Daily MBA, where business wisdom is served fresh and fast, straight from one of the top MBA programs in the world. I'll give you summaries of my lectures and readings, as well as the most important insights gained from an MBA, so you can apply all of this knowledge in every business. Let's get started. In today's episode, I'm going to explain how to do financial analysis. And if you've been following up all of my previous episodes, this is going to be the third step that you're going to do when you're doing a business analysis. Quick recap, we already did strategic analysis where we understood what the organization's strategy was and how it related to its industry. Then we did accounting analysis where we tried seeing if there was any manipulation to the financial statements and if there was any earnings management done. And now we get to the financial analysis. So here we already know what the firm is doing, how is it doing in comparison to its competitors, and if it's doing anything to change its financial statements. After we have done all of this analysis, we can know for sure that the numbers that we're seeing in the financial statements are accurately reflecting what the firm's operations are looking like. And so one easy way to do a financial analysis is going through ratios. Ratio analysis is a technique that is very commonly used to evaluate a company's performance by examining the relationship between the different elements of its financial statements. And ratio analysis is very commonly used because it gives many benefits. First, it helps analyze the firm's operating profitability, but also its risk. It also helps to break down the components of profitability and risk, and it helps you compare performance over time, which is going to be called time series analysis, but it also allows you to compare performance against the industry, and this is going to be called cross-sectional analysis, because ratios are something that you can take from the company, but also from other companies and throughout the years. So this is going to be a tool that is very, very commonly used, and it is a tool that can be done an easy way or a hard way. All of the ratios of the company that you want to analyze, because in Yahoo Finance, you already have a tab where you can find ratios, and they will give you the ratios. And these ratios can also be found in many other platforms, such as CapIQ, or any other place that is doing financial analysis is going to generate the ratios for you. The thing is, you don't know which things they are using. So when you're using the ratios that someone else did, either you have to trust that they are taking all of the sources correctly, or you have to do them yourself. So that's why I'm saying there's an easy version or there's a long version. One small caveat that I would say is that if you're using the ratios that somebody else already did, I would suggest that you stick to that same platform for all of your ratios comparisons. So either the time series or the cross-sectional analysis, because if you're changing platforms and you're taking CapIQ for one company and then Yahoo Finance for another company, then this is going to be messed up because every website uses maybe different methods and you can't know for sure if it's going to be the exact same ratio. It can be the same, it can be different. So just to make sure it's all aligned, I would suggest using always the same platform. But what my professor suggested was that always we should be doing it ourselves. Because if you have the statements and you know what to include and what not to include, then you'll know for sure that this ratio is reflecting what you really want to know. So in class, of course, I had to calculate all of this ones, and as a good practice, I think you could also try to do it because it will help you understand the financial statements better. But I'm going to start classifying all of these ratios into different groups of ratios so you can understand better what they are measuring and how they would be useful for analyzing a firm. So first group, I would use short-term risk ratios that are going to analyze the liquidity of a firm. And for this one, we have two different ones. We have current ratio and quick ratio. Current ratio is going to measure the ability to pay short-term debts with its short-term assets. And so the equation for this one is current assets over current liabilities, while quick ratio is going to be similar to the liquidity ratio of current ratio, but it's more conservative because inventory is not included. And inventory sometimes can be difficult to liquidate quickly, and that's why it cannot always be converted into cash. So the quick ratio is a bit more conservative. It won't include inventory. It won't include prepaid expenses. So it's liquid current assets, technically, over current liabilities. And so how would you interpret these ratios? Basically, if you get a liquidity ratio of 2, it says that the company has $2 of current assets for every $1 of current liabilities. So high liquidity ratios are generally going to be considered good, as they're going to show that the company can meet its short-term obligations. However, if you get a very high ratio, that could also signal that the company is not utilizing assets efficiently, because if they have so many current assets instead of current liabilities, it means that they're not reinvesting them. Okay. After we finish those short-term risk ones that are liquidity, we can move on to a long-term risk, which would be more related to solvency ratios. And for here, again, I bring two. First one is debt to equity ratio, and the second one is interest coverage ratio. So debt to equity is pretty simple. It's total debt over total equity. And this one's going to measure a company's financial leverage, assessing the company's risk and capital structure. While the second one, interest coverage ratio, is going to be EBIT over the interest expense. So this one's going to measure the ability to meet interest obligations, indicating how many times a company can cover the interest expenses with their operating income. So how would we interpret all of these ones? A higher debt to equity ratio is going to indicate a greater reliance on debt for its financing. And this can be good or bad. It depends. It only signals higher financial risk, but it can also signal higher returns if the debt is used effectively. On the other hand, a higher interest coverage ratio is going to indicate, of course, a better ability to cover interest payments, which is going to suggest financial stability and a lower default risk. So this one, you always want to have it very high or relatively high. Now, if we move on to another set of ratios, I would call this ones the efficiency analysis ratios. These are going to be 5 different ratios, and they're all related to turnover. So they are going to be inventory turnover, receivables turnover, payables turnover, fixed assets turnover, and total assets turnover. So we have 5 of these ones, and let's see what each one of them means. First, you have inventory turnover, and the equation of this one would be COGS over your average inventory. And this will measure how efficiently a company is going to sell and replace the inventory. And for this one, you want to aim for having a high inventory turnover. Second one is going to be receivables turnover, and the equation is going to be sales over average accounts receivable. This one is going to evaluate how effectively a company collects its receivables, and again, you're going to aim for a high amount. Third, you're going to have your payables turnover, and this one's going to be sales over average accounts payable. And this ratio is going to measure how quickly a company can pay its suppliers. And here, you don't want it high, you want to aim for low values because this is going to optimize your cash flow. The fourth one would be fixed assets turnover. And for calculating this one, you would get sales over average fixed assets. And this ratio would indicate how effectively fixed assets are used in order to generate sales. And caveat here, it will only be good for companies that have a high amount of fixed assets, of course. So as I was mentioning in my strategic analysis one, this ratio won't be very good for tech companies or professional services companies, for example. But here, you want to aim for a higher one. You want to show that you are very efficient when using your fixed assets. And the last one, the fifth one, is going to be total assets turnover. So this one is going to reflect on the overall efficiency in using all assets to generate sales. And again, you want to aim for having a higher number because this is going to mean that you're more efficient. So 5 turnovers: inventory, receivables, payables, fixed assets, and total turnover. All of these ones are going to measure your efficiency. Now, if I move on to the next set of ratios that I had, they're going to be called cash conversion cycle. And they are 4 ratios that are going to be measuring your efficiency with cash. And so we have days receivable, days inventory, days payable, and the cash cycle. And so as you see, this is going to be measured in days because we want to see how long it takes to do one thing or another. So days receivable, for this one, you're going to take your average accounts receivable divided over sales and then multiply that times 365 because these are going to be the days. And so the days receivable is going to measure the average number of days it takes a company to collect its payments from customers. And a lower ratio is usually better. Now, if we move on to the second one, days inventory, the equation for this one would be the average inventory over its COGS, and then multiply all of that by 365 again. And this ratio is going to indicate the average number of days an inventory is held before it is sold. So a lower days inventory suggests quicker turnover, but if it's too low, it might also mean it's understocking, for example. So you have to be careful with this one, but it's how fast the inventory is moving within a company. Third one would be days payable. And for getting this one, you would have your average accounts payable divided by your COGS, and then multiply all of that by 365. And so this is going to reflect the average number of days a company takes to pay to its suppliers. And a higher days payable is generally preferred because this is going to allow you to conserve cash for a longer amount of time. And after you already have this 3, you can generate what is called the cash cycle. So cash cycle is going to be days inventory plus days receivable minus days payable. And so this will measure the time it takes for a company to convert investments in inventory into cash from sales.
This episode is brought to you by State Farm. From your morning podcast to your afternoon playlist, State Farm knows you personalize your entire day. And that's why State Farm helps you personalize your insurance with the State Farm Personal Price Plan. It offers coverage options that help protect what you care about most at an affordable price just for you. Like a good neighbor, State Farm is there. Prices vary by state. Options selected by customer. Availability and eligibility may vary.
This is a message from sponsor Intuit TurboTax. Taxes was getting frustrated by your forms. Now, Taxes is uploading your forms with a snap, and a TurboTax expert will do your taxes for you. One who's backed by the latest tech, which cross-checks millions of data points for absolute accuracy, all of which makes it easy for you to get the most money back, guaranteed. Get an expert now at TurboTax.com. Only available with TurboTax Live Full Service. See guaranteed details at TurboTax.com/guarantees.
And what is preferred is a shorter cash cycle because it means it's being very efficient in generating this money. Now, if we move on into the next group, it would be the margin analysis ratios. And so these ones, they are going to be all from the income statement, and they're going to be the COGS margin, gross profit margin, SG&A margin, EBIT margin, and profit margin. So all of the margins that you can imagine, but this is going to break down how much money you are keeping in each stage of the production or of the company. So we usually start with the COGS margin, and this is going to indicate the percentage of revenue consumed by direct costs of goods sold. So a lower COGS margin suggests better cost efficiency because this is going to mean that you're only losing a little bit, let's say, with the direct cost of goods sold. The second one would be gross profit margin, and this one will measure the percentage of revenue that's remaining after covering direct costs. So a higher margin is going to indicate better profitability at the core business because here now you're including all of the direct costs. Then the third margin would be SG&A margin, and this one is going to reflect the percentage spent on administrative and overhead costs. And a lower margin is better because it will indicate cost control in the areas that are non-production. And then you will get the EBIT margin. So EBIT margin is going to show the percentage of revenue that's left after covering all operating expenses. And a higher margin is going to indicate stronger operational efficiency. Lastly, you'll get to profit margin. So this is net income over revenue. This will represent the percentage of revenue that translates into the net profit. So all of these ones are going to be useful for seeing where money is being left at, and maybe this might also be a trigger to help improve operations. Then I left two of the most important ratios almost for the end because they are going to be ROE and ROA. ROE is going to tell us something about the firm's operating strategy, and how we get it, it's going to be the profit margin ratio multiplied by the total assets turnover. And a high ROA is going to reflect better operational efficiency and asset use. And if we're looking at when is it useful, again, it's going to be more useful when it's asset-heavy industries such as manufacturing than for service or tech companies, because ROA, which means return over assets, it's going to be useful when you have assets that need to be effectively used. So again, this one you have to be careful, depends on the industry that you're analyzing, but it will be useful for companies that are asset heavy. The one that you should always look at, it's ROE, and this is going to be return over equity, and how we calculate it, it's going to be ROA times leverage ratio. We can use it in many ways, but this is a technique I used because if you already have ROA, you can use this. And the leverage ratio, which is the part that we're adding, is going to tell us something about the firm's financing strategy. And so what does this mean? A higher ROE indicates an efficient use of equity to generate returns, but it could also reflect a higher financial leverage. ROE can be inflated by excessive debt or through share repurchases, as both of these ones are going to decrease the amount of equity. So you have to be careful. If you don't understand what I'm talking about, you should rewatch all of my finance episodes where I'm telling you how we can decrease the equity. But so ROE is a very important ratio, but be careful because it can be manipulated. So after we have all of these ratios, the last thing that you could analyze would be the cash flow. Because I was telling you earlier that cash flow is usually never going to lie. Cash flow is going to be a very accurate source. And we can do three types of analysis in the cash flow. We can look at cash flow from operations, cash flow from investments, and cash flow from financing. And the words that are going to abbreviate all of these three are cash flow from operations, it's CFO, cash flow from investment, CFI, and cash flow from financing, CFF. So when you're looking at the operations part, this is going to mean how much money the company is earning or spending on operations. If you're looking at the investment part, is going to be how much money the company is investing into future operations. And cash flow from financing is going to tell you how much money the company is receiving or paying for financing its operations. So this one's, what they're going to tell you is what is a good state in the life cycle of a firm. Because usually it depends if a company is starting, if it's growing, if it's mature, or if it's declining. And so I'm going to show you in this table what it would usually look like for a healthy company. So if it's a new company, of course net income is going to be negative, but it should be growing. Cash flow from operations should also be negative, but it should be growing. Cash flow from investment will be negative, and cash flow from financing should be positive because this company should be getting money from somewhere. This table allows you to follow this life cycle of the firm, where it should be positive, where it should be negative, where it should be growing, steady, or declining. So it's a good rule of thumb. And if the company you're looking for doesn't have any of these correctly, then maybe that's a sign that it's not handling cash in the correct way. So after you have analyzed all of these ratios, I think the next step would be doing all of this ones for many years in the same firm. So in this case, we could take 2024, 2023, 2022, and 2021, or even 2020 if you want to take a 5-year horizon. And then you can see how these ratios are changing over time. That would be the first step to see if the company is improving. Then the second step would be taking all of those ratios that we just saw and analyzing them in competitors, because you want to see how this company is performing in relation to those other competitors. So as you can see, it's going to be a long process. You can do it the easy way with the ratios that are already made, or the long way, which is calculating each one individually. Either way, you're going to get to the conclusions and analysis that I just presented, but this is going to guide you to understand what is the financial performance of this company. If you like this episode, please share it with another friend that wants to learn about MBA topics, and give me a review or tell me in the comments what you thought about this. It will help me a lot, and it will also motivate me to keep sharing all my knowledge and all my notes with you. I'll see you in the next episode where I'm going to teach you how to do a proper prospective analysis. See you next time.